as long as we play within the parameters of what the IRS has given us, we get all of those tax benefits, meaning we can overfund it up to a certain point.
Mm-hmm.
So when we build these policies, we're building them so that we're minimizing the costs to create the specific benefits that I've been talking about.
Are you ready to transform your life? This is a no-nonsense show helping immigrants like you create generational wealth, even while working full-time. Get ready to take notes. Here's your host, Saket Jain.
Welcome back, my Great to Wealth listeners. Today, we have the pleasure to talk about such an interesting topic, life insurance. But I trust you. Hang with me. It's going to be an exciting conversation. The guest I have today is president of Money Insights. His name is Rod Zabriskie. Rod, how are you?
I'm doing great. Glad to join you.
Yeah, I'm sure you won't let me down, man. We're going to make life insurance interesting, won't we?
Yeah, they'll know more and they'll be more excited about it by the time we're done.
There you go, Rod. So, Rod, I know you and I have talked about it a lot. Folks who know me, I am the Dave Ramsey and Susie Orman generation where invest in term and buy the term and invest the difference, right?
Yes.
So we're going to bust that myth. That worked for some folks, right? So we're going to talk about who's that advice for, and more importantly, who is that advice not for. But before we go that, we always start this show with your migration story. How did you get to do what you're doing?
Yeah, it's a great question. It started back, as I'm sure many people who listen to this, with Rich Dad, Poor Dad. So I was in college and I found that book. I read it and I was really impressed with just this idea of living life differently, building wealth differently than, well, certainly, like you said, the Dave Ramsey kind of model is very different than the Robert Kiyosaki model. So I kind of caught that vision. And so I've been ever since then, working toward being a business owner, investing in real assets that can give us cash flow and or tax advantages, et cetera, working towards this place where I'll have enough passive income to replace my working income. So I already had that mindset. And then I got working in the insurance world. And so the coming together of those two worlds, basically where I was able to take the kind of expertise that I developed in life insurance specifically, and kind of marrying that with the cash flow, moving money in and out of the investments in a business, in a lot of different ways, but just basically making it do more for me than I was able to do otherwise, like running it through a savings account or something like most people do.
And how did you get into the insurance industry? Of course, that's not Robert Kiyosaki's teaching, right?
No, he
doesn't talk about that. So how did you get into the insurance industry?
Yeah, so let's go back to 2007.
Let's do that.
I actually had an opportunity to buy a furniture business. So that was my first business, becoming self-employed.
Right.
And everything was going great until, of course, fall of 2008, everything had crumbled. All of our customers, I was wholesaling to furniture retailers, and they were all done, right? Like, hey, we're not going to be building our storerooms, anywhere. We're just going to sell it as, it's ordered. So the kind of good news, bad news about that is it became very clear, okay, I'm not going to try to stick this thing out. I got to figure out something else. And after trying a couple other things, I ended up deciding to set up a health insurance business, which I did. And in the course of doing that, that was
pre-Obamacare time, man. That's amazing.
Well, yeah, that's the thing, exactly. So pre-Obamacare, I'm doing health insurance, but then as that all developed, it became very clear that world was going to fundamentally change, which it did.
Yeah.
But I was also in this mode where I was wanting to engage with people at a different level than I was with just this kind of transactional relationship of giving them the health insurance that they need. And so I was already kind of in expansion mode. So it was really easy to add life insurance, disability insurance, long-term care insurance, these other types of things that are related. I can work with the same people. And as things morphed, I ended up leaving health insurance behind. I no longer do any of that. And again, this focus on not just life insurance as a whole, but using life insurance strategically to enhance and make things better for alternative investors.
Yeah, and when you were exploring that, Rod, I think we got to address the elephant in the room, right? Because you and I both know, and a lot of our listeners know both Dave Ramsey and Robert Kiyosaki.
Sure.
And they both come from two different worlds, and they're serving two different audiences. They're different purposes. Their purpose is very different. So when you were going into the insurance industry, of course you had a conflict, right? Because Dave Ramsey is talking about something else. And I'm not saying he tells it wrong, but it works for some people.
Sure.
And of course, Rich Dad, Poor Dad, Robert Kiyosaki is talking completely different language. How did you make the two worlds meet? Like
it's a great question.
Make sense of it?
Because that was a conflict from the beginning. Like just from my upbringing, I grew up in Utah, good, Mormon, Latter-day Saint, upbringing, very conservative. And so that Dave Ramsey message resonates, especially because of his attitude toward debt and that kind of thing, right? And then I read Rich Dad, Poor Dad, and I get this vision of what things can be. And so you're right, bringing those two worlds together, it's not a match, right? There's not an easy way to bring those together.
You have to pick one at that point, right? At some point you have to say, I'm going to live in this world, or I'm going to migrate to another world.
Exactly. And I think there are some principles of what Dave Ramsey teaches that still work really well. Because, he's talking about, build up an emergency fund, be smart about what you're doing, which all of us can agree with, right? Regardless of where we are and in what directions we're headed. But then it gets to a certain point where when he starts to talk about how to invest and build up towards retirement and all those kinds of things, the worlds diverge in opposite directions. And so I would say, but even before I knew or started doing what I'm doing, started working in the insurance world, I had heard things about cash value life insurance, whole life insurance. And to be honest, it didn't make any sense to me. Like life insurance is supposed to take care of, my family if something happens to me and I die. What's this whole thing about cash value and all this kind of stuff? So starting from that really simplistic beginning of seeing it for what it is and understanding it, to getting to a place where we are now, where we know all of the ins and outs, how to build a policy in the right way to optimize toward the cash value, minimize the costs, and then use it in conjunction with the alternative investing world has been a big shift, right, from where I started. But it was just kind of piece by piece, just like a lot of things, right? Little bit by bit, learning here, learning there, creating some expertise inside of the insurance world to then bring all the pieces together.
Yeah, so let's actually pull this thread for a second, because you talked about something very important, right? That until you got into this business deep enough for you to understand the business from ground up, you're thinking of life insurance as a death benefit product, right? That eventually every one of us is going to pass away, but when we pass away, we want to leave a certain amount. And the thinking always is, how much can I buy my death benefit? How high can I buy my death benefit for the least amount of premium? That's what they're thinking.
Exactly.
Right? Yep. Because they're thinking, I've contacted some insurance agents on my end when I was novice in this world about financing, right? I'm like, okay, just tell me I have $10,000. What's the death benefit? No, I'm not happy with that death benefit. Let's talk about $15,000. What can $15,000 buy? What can $20,000 buy? Yeah. And then I'm like, what can term buy? Completely change the conversation, because the focus was predominantly death benefit. Right?
Exactly. Yeah.
But I'm assuming what we were talking about, there's actually a paradigm shift in how you started thinking about insurance and how you're approaching your clients as not only a death benefit, and that benefit could be a purpose for that whole life insurance, but there's actually a whole sliver of whole dimension that most agents don't talk about, most strategists don't talk about. So give us your perspective on that.
Yeah, it's a great point, because it seems like at least the perception is you have to either believe in term and then, like you said, by term invest the difference in other places, or you have to jump into the bandwagon with the cash value life insurance, whole life insurance, et cetera, and go that route. Well, that's not true. You don't have to choose one or the other. You can actually do both. So what we're doing is we're saying, hey, as it relates to life insurance, we're choosing this as a vehicle to enhance the investing that we're doing, not necessarily because we're looking for life insurance per se in that context, but because what we can do with life insurance and the laws and rules around life insurance just allow us to do things a lot better. So for example, I talked earlier about how most people who invest in real estate, in other alternative investments in their own business, typically are building up their funds they're going to use for that inside of a savings account or maybe a money market account. And why do they choose that? Because of the safety and liquidity.
Right.
They are not choosing stock market, other things that are risky, because they need the money to be there and ready for them when the opportunities come along, right? Well, inevitably what we find is people get a little disenchanted with that because they have the safety and liquidity, but it's just not doing anything for them.
Right.
while it's waiting for a deal. And so especially at times like now where the deals are harder to find and inflation is going crazy, that money sitting there is just like driving people nuts. Right. Well, what life insurance and what, again, specifically the way that we design these whole life insurance policies, what we're doing is we're creating a place where you get the same safety and liquidity, but you can generate a long-term 5% plus consistent return. That return is tax-free, and you access it and use it for your investing. So you're still doing the same investing as you were going to do anyway, but this, what I call the opportunity fund, is just much more efficient, creates another level of profitability in addition to what you're able to generate with the alternative investments.
So I think what you're basically saying is you got to compare apples to apples, right? So what you're saying, you can't take the cash value and compare with a real estate deal where the IRR is 18%. Those may not be the right comparison. That's
exactly right. Yeah, because you're not choosing. You're actually doing both. You're putting the money in the policy first, creating this now bucket of money that's there, and it's going to grow and create this compound growth, whether you end up using it to go out and invest or not. Because when we actually access it, we're not taking it out of that bucket, we're loaning against it. The insurance companies have this ability to take a loan against it. So when I'll speak personally, I put that money in that bucket, the life insurance policy. When I'm ready to go out and invest, I want to take, $50,000 to go put into a syndication or something. I'm not taking that money out of the bucket. I'm taking a loan from the insurance company of $50,000 using my cash value that's in the bucket as collateral. And I'm using that loaned money to go out and invest in this syndication, which means that the money in that bucket stays there and it continues to grow even while I'm doing that. So I'm creating value in multiple places at the same time.
So I'll actually K through 12 it for our listeners. I know this is second nature to you. So you've done a lot of good things there. So I'm going to actually dumb it down, right? So Perfect. I think what we want to understand here is that life insurance in general has two aspects to it. A whole life insurance. It has a life death benefit component, which is important to consider. But what we're saying is put more emphasis into another bucket, which is called cash value. So when you're paying your premium in the life insurance, whatever you're contributing is probably the better way, not just the premium. When you're contributing to life insurance, a part of that money is going towards cash value, right?
Correct.
And the other part is going towards covering the cost of the insurance. So the way we're redesigning this whole thing is, and not every agent is created equally in this world, because you as an agent, I know you as an advisor, I know you get less money if you don't increase the death benefit, but we're doing a good job. We're making sure our investors' interests are met, right? So that's how we're designing it right. We want to maximize the cash value. And why are we maximizing the cash value? Because the cash is compounding at more than 5% on an annual basis. You use that money or not. So where can you use that money? Let's talk about those buckets, right? So if I understand correctly, and you tell me if I did, first of all, the concept is your cash value life insurance is essentially like a home equity line of credit, right? Your house is going to appreciate in value no matter how much home equity line of credit or other loans you have. It's going to continue appreciating, right? Which is really what we're saying in cash value insurance is, if you have 100K sitting in your cash value in a whole life insurance, you can take a portion of that loan while your cash value is still compounding at 5% on more.
Correct.
Right? So I think that's one important concept. Now, why would you use that? What you're saying is, instead of creating an emergency fund and putting in a bank, and of course, for the last few weeks, we've seen what happens to the banks, what could happen to the bank. That's a completely different story, right? Here, your money is with an institution that is heavily regulated, and they're not leveraging that money out in a way that the banks are, right? The banks are fractional banking system. Their leverage is 10 to 1, which is not the way the insurance companies are, because a lot of the insurance companies are providing death benefits, and they want to make sure there's enough liquidity for that, right? So part of that is what we're saying is the cash value is more important, because you can dip into the cash value to go buy a different asset, which can then give you 18, 19, 20% IRRs. And there's some investments we were talking off air could have to an IRR of up to 25, 26% if you can pair it correctly. And then you pay off that loan that you took cash values on, and buying a cash flow asset actually helps you pay that off, right? And then you can redip again once you pay that off, but while your money is still compounding. Did I characterize it correctly, Rod, or did I miss something?
Absolutely. Yeah, you're absolutely right. And maybe circling back to your original question, well, so why there this big difference between term and whole life and these kind of cash value products? So the way that we approach it is we say, hey, for those dollars that you're putting into your investments, let's direct those into the policy first, optimized to grow the cash value. And that does create some insurance. That's insurance you don't have to pay for any other way. It may or may not create enough insurance for you to feel comfortable for your family or for business partners or other people who get left behind if something happens to you. So you have, I'll speak for myself, I have whole life policies and I have term policies.
Right.
So I can take care of both. I'm optimizing both.
Correct. And I think that we're basically saying it's not an either or.
Correct.
There is actually an and available there. And what to kind of maybe take one level up from what Dave Ramsey or Susie Orms of the world are saying, you're still investing the difference, but you are introducing a cash value life policy in between because you're leveraging that. You're making your money go even further.
Yeah.
By introducing a cash value.
Yeah. And the other thing I would say to that as well is that the kind of whole life insurance policy that they're talking about is very different than the kind of policies that we're creating. Because
so what are they talking about? Give a little bit more context on that.
Yeah. So a vanilla whole life policy, it will build cash value and it will, maybe in the long run, you might end up with maybe a 2 or 3% IRR, but it takes a long time for that money to start building cash value. It might be in year 2 or 3 before you start see any cash value being built in just a plain vanilla type of whole life policy. Well, in the ones that we're building, we're overfunding the policy dramatically, right? So in other words, we set up kind of this core life insurance policy, but then we have the ability to put extra money into it. And you say, well, why would you do that, right? Well, because we want to capture these benefits. We want to put it in a place where it can still be accessible and still be safe, but be growing at this compounding rate, like I said, 5%, but also tax-free. That's the tax benefit that comes with it. And as long as we play within the kind of the parameters of what the IRS has given us, we get all of those tax benefits, meaning we can overfund it up to a certain point. So when we build these policies, we're building them so that we're minimizing the costs on the kind of that pure cost side, overfunding it up to the max limits that we can to create the specific benefits that I've been talking about.
So, and thank you for sharing that, Rod. So, one context, I just met a friend of mine yesterday for coffee, and we were talking about this concept. He's like, don't talk to me about whole life, right? I just had a life insurance policy for 18 years. After that, I just stopped paying my premium. I had to surrender all my cash or whatever it was. I can't even remember the cost. I lost them within 18 years. That 18 years, your cash value didn't grow that much. So that essentially means it was structured incorrectly, right?
Gotcha.
So help us understand that because when people are saying that, Dave Ramsey, we'll just use him as an example, and he's not the only one saying it, that a whole life insurance is more beneficial for the agent who is, and I hate that word, but agent who is actually selling you that versus for you yourself. So come back to that, Rod?
Yeah, it's a great question. And I also will clarify with this that there are different types of life insurance policies. Whole life it's kind of like the granddaddy of them, been around a long time. It has a lot of guarantees associated with it. So when I talked about it creating this, 5+% return, well, how does that happen? They have a guaranteed interest rate associated with it, but then they also pay a dividend. The insurance company will pay a dividend, and that's what creates that growth for us. For someone like your friend, if it's truly a whole life policy, even if it's not designed that we do it, but you were paying your premiums for 18 years, you would have more in your cash value than what you had put in. Okay, because again, with those guarantees and with just the way the dividends work, et cetera, it would do that. So, but again, there are other types of life insurance. There's universal life, there's index universal life, variable universal. So when you start to get into some of these other types of insurance, still cash value life insurance still has some of the same characteristics I talked about. But when you talk about how the cash value is set to grow in those cases, then it depends. It depends a lot on how it's designed, but also a lot on what happened with the market or with the growth factors inside of it. So it is a matter of, finding someone that you can trust to build it correctly and do it in a way that is optimized toward what you want. Because again, if it is just death benefit that you want, we would approach that very differently than we do for someone who is saying, hey, I want to use it as this kind of opportunity fund for my investing.
Yeah, I think that makes sense, Rod. So Rod, what if, and we touched about it, what should people watch out for? So let's just say they want it beyond the death benefit, because what we talked about is the right way to look at this is get your death benefit from the term. It's probably going to be the cheapest option, but use the whole life insurance in parallel to as a product along with your term to make sure you can maximize your cash value as well, right? So when someone's structuring it, what are some of the key things they're looking for, and how do they vet the insurance agent or insurance strategist they're working with? What are some of the key?
It's a great question. And I would say it's kind of like picking an attorney, right? So I know I need an attorney. Well, it depends on what I need them for.
Right.
That helps me decide who I'm going to work with. So if I need an estate plan put in place, then it won't do to just go to any attorney and ask them to put that together for me. Right. I might find an attorney who will say, yeah, I can do that for you, but they may or may not have the expertise behind that, right? Maybe it's like a family law attorney that says, hey, yeah, I can do that. But I won't get the same result as I would if I went to someone who has the expertise in the specific things that I'm looking for with my estate plan. So kind of drawing that parallel now over, could you go to a life insurance agent down the street and walk in the door and say, hey, will you build me a whole life policy? And they would say yes.
I'm sure they will.
And if you described it exactly the same way as I've been describing it here, they will build you something, but it won't likely be optimized the way I'm talking about. Because just because someone deals in life insurance doesn't mean they know all of the things that they need to know to build it in the right way. So back to your question, how would you find someone? It needs to be someone who has that expertise. So when you talk with them, they can speak your language and you say, hey, I invest in real estate. I have a business. I want something that is optimized toward building that. And so, for example, when we're having that conversation with someone and the question comes, okay, well, how much do we need to put in place? It's not a matter of saying, how much insurance do you want? It's a matter of saying, how much do you want to be putting in the plan? In other words, the ideal scenario for me is I want to get all the money that I'm going to be putting into my future investments into my policy first. That's how I decide how big of a policy I need, because I just reverse the formula that I talked about earlier, take the money going in, say how much insurance do I need to support that without paying any more cost than I have to, and we build it that way. So again, these are, hopefully you're getting kind of a feel for the way those conversations go, because is it life insurance? Yes. Does life insurance matter? Yes. But is the conversation about the death benefit? Not necessarily. Not as a primary driver.
I mean, it could be for some, but I think what we're saying is the product you're offering, that's not the main driver.
Right. And the design of it is all about optimizing the growth of the cash value to be using in these ways we're talking about.
I think, Rod, this actually makes sense, right? So, Rod, what's the best way to tell if somebody's interest is not aligned? Because there are lots of agents, like down my street where I live, there's a State Farm insurance retail place, right? And of course, online, there's so many, right? So how do you, of course, you are one of the sources. That's why I brought you on, right? I mean, you've been doing it for a while and you've been in the circles that I surround myself in. So you're definitely one of those guys. But let's say if somebody wants to say, hey, I want to try different options as well and get a little bit more understanding than just what Rod and Saket are talking about, where would they go? What would be their first step on Google? What are they looking for?
Okay. So there's kind of a community out there of infinite banking. That may be a term that people are familiar with. We do differentiate ourselves a little bit from them, but that would be at least a place to start, because for infinite banking practitioners who do it right, they're going to build the policy the way I described, where it's minimizing cost and maximizing the cash value. The only reason I say that we differentiate ourselves is because we are hyper-focused on using these policies to go out and invest. Whereas the typical infinite banker, they're going to talk about all kinds of different ways and reasons why you might want to use your cash value to buy cars and go on vacations and do all these other things, which again works, right? You can take loans and use it for whatever you want because you have that cash sitting in that bucket acting as collateral. The insurance company doesn't care what you're using the money for. They're not even going to ask you. But again, our focus is on saying, hey, let's use it to create value. Kind of going back to the Robert Kiyosaki model. How do I know it's an asset? If it creates cash flow for me, right? So we want to be using this as an asset and as an extra like asset builder. towards, again, creating that extra level of profitability above and beyond what my actual investments are doing for me.
Yeah, I love that. So Rod, in terms of, you also mentioned something that this is very tax efficient, right? So let's talk about 2 stages in life. So let's say somebody is 30 years old and they want to build their cash value, grow their cash value when they're, let's say 60. We'll make an arbitrary age. That number may vary personally. And then between 60 and let's say 100, they want to use that money now. How do they dip into the cash value insurance, cash value life insurance beyond 60 and make that distribution tax free? How does that work?
Yeah, it's a great question. And I call that phase 2. So phase 1 is I'm putting the money in, I'm using it to go out and do my investing. But then eventually I'm going to get to a place where I'm slowing down on my investments. I'm going to be living off the cash value that's coming off of those investments. And now I've built this asset inside the policy in addition to all the cool stuff I'm doing with real estate or with my business or whatever. So at that point in time, I can tap into it. It's an asset. There's cash value there, and I can use that. And what we'll do is we'll basically build it. We'll put it this way. I can access the cash value through a loan, right? We already talked about doing that in the investing side. Well, I can do the same thing now with my, we'll call it retirement cash flow, right? And when I do that, I'm basically tapping into it through a loan, but I'm not planning to pay it back now. When I was investing with it, I was creating cash flow. I take that cash flow and I flow that back in to pay down the loan. Now I'm using it. I'm spending it. I'm not wanting to flow and that's okay. Again, because I have that cash value that's acting as collateral against that loan. It will continue to grow. Now I have a loan. The interest will accrue, but that's okay because the accrual of the interest on my loan is being offset by the growth of what's happening in my cash value. Right. And then eventually what's going to happen is when I pass away, there will be this outstanding loan, but that's going to be paid off by my death benefit. Death benefit, just by nature of what it is and the way that the laws are written, is income tax free. Right. So I have this enormous, lump sum of income tax free death benefit that's paid out. That's what's being used to pay off that loan that I've built up. And because of that, I've just been able to get all of that money back out tax free.
I love that. Right. So I think let me just see if I can simplify that for a second.
Sure.
So again, dumbing down is very important.
That's great.
So when we're looking at this, right? So why is the first phase important? Because I think what the insight there is, the more time and the more money is sitting in the market compounding, the better your base for the phase 2 is.
Sure.
And the reason for that, why it needs to be a big amount, is because you want your living expenses to be lower, ideally, than the interest, than the returns being generated in your cash value, which is about 5%, right? 5% plus. So that's really, if you put the money now, if you were in a phase 2 tomorrow and you put the money now, you need to put a big amount because you want to make sure that the interest in that is higher. But that's not the reason to do that. What we're saying is the more you can create, give the time for phase 1, the more amount you'll have, the foundational amount you have in your phase 2. So your starting principal is higher. So the returns that you're making on that is going to be much higher than the loan amount that you're taking, and which essentially means you will never have to repay the interest on the loan. You're choosing not to pay repay the loan as well. That's okay. But you're not doing that. That's really why phase 1, the earlier you start, is very important. But let me ask the question, what if I'm 50? Does it still make sense? This policy?
Yeah, it's a great question. And the answer to that really depends on your timeline. So if you're 50, but you're saying, hey, Rod, I'm going to be essentially retired by the time I'm 53. I'm not going to be, continuing to invest and do all these other things. That's probably not going to work. But if you're saying I'm 50, I'm going to be doing this investing for the next another at least 10 years or whatever, or even 5 years, then yes, it could absolutely work. So it isn't as much about age as it is about the timeline, because we have people getting into these policies even in their 60s because their time horizon is out there and it makes sense.
Right. Well, Rob, I can talk about infinite banking for a long time. I know with you guys are so great at it. But I want to respect for your time. I know we have a hard stop in the next 5 minutes here. So why don't we switch to the second part of our show, which is really about 2 things. One is, you've done quite a lot of different things in your life, right? Of course, life is not fair to anybody, and neither it should be. If you were to go back to your 20-year-old self, right, the era that you grew up was a Dave Ramsey era, and it still is for some people. And then, of course, you got exposed to a lot of different things in life. If you were to go back in time and you were going to tell your 20-year-old self some insights that will make their migration in life much more productive, what would that be?
I think the thing that I've learned that would have been most valuable for me, and quite frankly, the stuff that I'm trying to teach my kids, because they're now at that age, is the variety of ways that you can invest. So my idea of investing in real estate was exclusively in buying a piece of property and renting it out and becoming a property manager.
Right.
And that was just such a daunting idea for me. I loved the principles of Rich Dad Poor Dad. And I had this kind of vision in my head that I would, buy a duplex, live in half of it, rent the other part out, etc. And that didn't materialize for a variety of reasons. But if I knew then what I know now, I would have looked beyond those kinds of things to do that. Right. And I realized that some of the things that in real estate syndications and other things, sometimes you have to be an accredited investor. And I certainly wasn't at age 20. But there are a lot of ways that you can do it without having to be accredited.
You can.
Right.
Yeah.
Wholesaling and even syndication investing. There are a lot of syndicators out there who will put together deals that can include non-accredited investors.
Right.
But then again, a lot of these other things, house hacking, and there are a lot of different ways to do it so that you can take advantage of the benefits, not just the cash flow, but the tax benefits and all the other things without having to become a landlord.
Correct. Or without having to do W-2.
Exactly.
And trading time for money, right? So it's more for both. You're basically saying, look at investment as a ticket out instead of investment as something so daunting that you don't know where to start. It's just kind of like how you asked that problem. The last question, my friend, is what's lacking in the humanity right now from your perspective, right? When you talk to a lot of folks, right, in your business, you talk to a lot of folks who have their fears, their concerns, their assumptions, but it's really something else is bothering them. Money is just a symptom. It's not really the cause. So when you're looking at, if you were to reflect back on that and the humanity as a whole, where should that be migrating towards?
It's a great question. I mean, I think as a whole, I'm amazed that society can exist the way it is and we get along as well as we do.
Right.
And what I mean is, I think by and large, people's hearts are good. They want to do good. And then, but it just comes down to kind of, like you said, some of those fears. I think a lot of times when we aren't kind, when we don't kind of show that human side of us, it's because of fears, because of misunderstandings. So I'm careful when I talk about this kind of stuff because I don't want to feel like I'm, the woke kind of thing.
Right.
But I do feel like if we can see each other as people and treat each other as people instead of as objects or as potential reasons to be fearful.
Sure.
And that can just make a huge difference in just the way that we interact. And when that makes a difference in the way we interact, then it makes a big difference in the society as a whole, the kind of, example that we can show to society of how we can get along, we can be different, which is good, which is valuable, and contribute in different ways and all build together, but do it in a way that is where there's kindness, where there's that kind of underlying human love that kind of drives what we do.
And I love this question, man. I really get to see the human side of everyone, right? I love to ask that question from people. And I know you're not just saying it, you actually run your whole practice like that. Right?
I try to, yeah. And I won't, pretend that I don't have my own fears, my own things, where I don't, I don't always treat people the way I'm describing, but
that's
at
great,
least if
man.
we're all striving towards something like that, then I think we can, it could be a better place.
Well, if you aim for that, maybe if you miss 1%, that's still okay.
Yeah, absolutely.
Right? Because you're going to keep, everyone's got life's continuous change and improvement. So that's going to happen.
Absolutely. Yeah.
Well, Rod, on that note, we're coming to a time here. Where can our friends, my audience, find you? If they want to learn more about you, your offering, they want to talk to you about infinity banking, where can they reach out?
Yeah, great question. So like we talked about, our company is called Money Insights. Our URL is moneyinsightsgroup.com. So if you go to moneyinsightsgroup.com, you'll see a lot of content. Go to the resources in our education center where you can see a lot of, we try to be very educational about what we do because it's not intuitive, right? People don't just wake up and say, hey, I know exactly what's going on with life insurance and what these guys are talking about. So if you can go there, we have webinars, we have white papers, we have what we call our investor quiz. If you take that, then we'll have, you'll get some curated content that's more specific to you and the way you're investing and what you want to be investing in. So that's what I would suggest is go to that website, take the quiz, check out the education center. Like I said earlier, it's not that we don't like the term infinite banking. We just like to differentiate ourselves. So look for the investment optimizer. That's the kind of the strategy that we've been describing today.
Awesome, Rod. And I want to acknowledge your time, your effort. I also want to say that I'm going to be bringing Rod a lot more and his team, because I really believe this product has a lot of legs and a lot of room to be one more quiver, right? Kind of like make sure that one more tool in your toolbox to use against creating your generational wealth, to creating financial freedom, and multiply your money even faster. More on that. Rod, thank you again for your time, brother. I appreciate it. And I'm going to see you soon.
Awesome.
If you got value from this episode, you might consider sharing this content with a friend. But most importantly, be sure to take action on what you've learned. One way you can take the next step is to connect directly with Socket on an investor call. That link is waiting for you in the show notes below.
The content of this podcast is for informational purposes only. Please consult your own advisors when making any investment decisions. Keep listening. We'll see you on the next episode.